So it's Fed Day, Wednesday, and the Fed just made their interest rate policy decision. They cut the interest rate by a quarter point. And it's so funny to me because unless you're in mortgage, even if you're a realtor, you don't understand this. Nothing personal, but I talk to realtors. So our phones are about to start blowing up. They already have with, oh my God, the Fed cut rates. What are mortgage rates now? Or should I refinance? Or blah, 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 fill in the blank. And so it's so fascinating. So we're trying to do this in a timely fashion today to talk about that. Why don't you kick it off for us? What is a Fed funds rate and how is it different from mortgage and yada, yada, yada?
Fed funds rate affects short-term rates, so your credit cards, your car loans, not mortgages, because mortgages are 30 years. So while they say that mortgage rates can rhyme with what the Fed rate is doing, they certainly don't go one-to-one. And as we've seen over the last few months, they don't even necessarily go in the same direction
In fact,
the same time.
Pretty much every single time.
They go the opposite direction.
As soon as the Fed started their interest rate cutting cycle, and we're talking about a 50 basis point cut, which was a surprise cut, which was their first effort, interest rates did what? They rose.
They went up.
Yeah.
Yeah.
And then we've had 2 additional quarter point cuts, and each time when I say mortgage rates went up.
Went up, yeah.
And just like from a technicality standpoint, the federal funds rate is tied to short-term rates. What does that mean? Okay, so when you get your credit card statement in the mail every month, you're going to notice your 29% interest rate is now 28.75%.
Right. So the one exception in mortgage are home equity lines of credit. They're typically tied to the prime rate, and the prime rate will follow the Fed rate. So, yeah, if you have a HELOC on your house, congrats, you just went down 0.25%.
Yes. HELOCs are the exception to the rule in mortgage.
Yes.
Now, I'm not going to go, and nor is Mike going to go into any more granular detail than that because we don't want to confuse you. And we like nerding out on that stuff, but you probably don't. Just the point is, we're going to try to dissect this in a way that's easy to understand. So why, in your best way to articulate it, why are mortgage rates rising every time the Fed cuts short-term rates?
It's because mortgage rates are, when they're long-term and they're looking at inflation, they're saying that if money is worth less in the future, then that causes mortgage rates to go down because the long-term investment isn't as strong, right? People are going to move the money elsewhere. So when the Fed comes out and says, we're not as optimistic of what's happening with the economy and the inflation numbers. We think that things are still inflationary, thus your long-term money is not as valuable. So because of that, we're not going to cut as much. We're only going to do 50 instead of 100 in 2025. The bond market, which mortgage rates are tied to, says money in the future isn't going to be worth as much, so we need to charge more money now.
Yep. They want to be paid a premium for that. So all that to say, the Fed's language. So I don't know if you notice or if you pay attention at 11:30 Pacific Standard Time is the actual press conference where the Fed answers questions. And that's what everyone's paying attention to. And lately, he's like, yeah, we're going to cut. However, we're still not happy with where inflation is. So it's that language right there where he's like, we're not there yet, guys. So we're still going to cut, but we're keeping a careful eye on things because we're worried about inflation still. That's what's keeping interest rates elevated because the market says, oh man, inflation's not dead. We haven't put the genie back in the bottle. That's it in a nutshell. And then, it's been really frustrating because we've got economic data that's all over the map, right? Ultimately, this far into an interest rate increase cycle, a tightening cycle, what are we, 22, 23, end of 24 now? Generally speaking, 3 years into a tightening cycle like this, the economy has noticeably slowed down. And the problem is retail sales is still pretty strong. The consumer, credit card usage, credit in general, it's all pretty strong. Travel, right? If you're you can look at anything you want, and on one side of the fence, it'll say, oh my God, the economy's in recession. On the other side, it's showing the economy is doing really well. So we don't have a clear consensus about where the direction of the economy is going. And at the end of the day, 2.9% inflation is not where they want it. They want it at 2%.
And I think that when you look back at what the Fed has said over even just the last year, you realize how fickle it is, right? The reason that we saw a decrease in mortgage rates just a few months ago was because the Fed was saying that, hey, we feel better about where inflation is, so we're going to start cutting, and the market's like, yay!
So the language, right?
It's a lot of the language. And we're just a few months removed from that, and it's back to, oh, maybe it's not where it needs to be, and then the market's adjusting. So I think that, we talk about there's no perfect timing of the market if you're a buyer, right? What's happening in your life and your motivation to buy a house is the most important piece, because a house is shelter. And sit tight, because in a month or two, when they talk again, it could be entirely different. Just depending on what the reports say between now and then. And so it's a short-lived thing many times.
That's a good segue, actually. So how do we translate this over to realtors and buyers, right? Because you're bringing up an important point. None of this stuff is anything anyone controls. And I was just reviewing his home buyer presentation for his BNI chapter happening tomorrow. We'll be sharing that shortly, so stay tuned. But we get so caught up in the minutia and the granular detail and the financial aspect, which I understand that is important. But we're also forgetting that we're human beings who have a very basic need in life. And that need is
shelter.
Yes. And we get, what are the 5 Ds, if you care to share that real quick?
Oh man, you put me on the spot. So, number 1, diploma. After you graduate from school, you get married, so diamond. And then you have babies, so diapers. And then things take a turn. We joke.
It's called stress.
Yeah. But
divorce
and death.
And death, right. So what he's pointing to the reasons in life as human beings that we actually have a need to buy a home. Now, if you can't afford to buy a home, you're going to rent. But there are people out there who have done well in life, well enough, and maybe it's a single income, but you're doing well and you've got support from family, gift funds, whatever. All this to say is, like, if you've got the ability to buy a home, none of this should be stopping you. Right. Yeah. So it's a whole nother conversation, but just because interest rates aren't low and affordability is not really attractive right now, doesn't mean it's not a good time to buy a home. Do you have an opinion on that?
Yeah. Well, what we put together in the presentation was the housing index. And if you're trying to time the market, which in my mind is a scenario what people did in COVID, right? We think that it's here, we're in for a dip, so I'm going to try to sell high, buy low.
Right. Timing the market.
And in that scenario, there was 1 year in the last 20. At least that's where.
Think about that. But go back even further, though. Wasn't it in the last 50?
In the last 50 years, there were 7 years, according to the FHFA, that had depreciation on home prices.
Right.
And most of them weren't consecutively.
Yeah.
So the chances of you lining up those 5 Ds where you buy and sell real estate with a year that you have a depreciation followed by appreciation, right? It's just the chances are nil.
Yeah.
And I think that what we're going to be coming into in the next few months here is that, real estate is cyclical with the seasons. We're heading to the winter season where prices tend to naturally come down just a touch, right? So regardless of where mortgage rates are.
And if they don't come down, they stabilize.
Yeah.
And it's probably the more appropriate term is stabilized prices rather than coming down. It just depends on the market, right?
Right. We're short on inventory, so stabilization is probably a good way to put it. So even if rates are a little bit higher, if you ever were going to have a part of the real estate cycle where you get a deal or at least somewhat of an opportunity to negotiate with a seller, it's going to be over the next few months.
Yeah. Because once spring busy season comes, demand is at its peak, and that means hot competition, multiple offers, bidding wars, and buying real estate stressful in and of itself. And then when you add in the seasonality aspect of spring busy season, some people just throw in the towel and say, screw this, I'm giving up. Right. At the very beginning of your presentation, I liked what you said on one side and the other. A lot like mindset, right? What was it? It was some people wait to buy real estate.
The saying in real estate is
there's 2.
Don't wait to buy real estate, buy real estate and wait.
Buy real estate and wait. It really takes out the complications in it and overthinking it and resisting it. Just buy real estate and wait. Anyway, we can get into more, but bottom line is when you're thinking to yourself, oh my gosh, the Fed just dropped interest rates 1/4 of a point. Guess what? That has nothing to do with mortgages. And in fact, because of the inflationary concerns right now, at the end of the day, mortgage rates continue to go up. Sorry, don't shoot the messenger.
Yeah. Good way to put it.
Thanks, everybody. Until next
thank you.
time.